Have you ever wondered why, despite years of schooling, we often find ourselves lost when it comes to managing our own finances? It's a curious thought, isn't it? From algebra to the intricacies of world history, our school days were packed with lessons. Yet there's a gap where essential life skills like personal finance reside. Today, let's bridge that gap together. In this enlightening journey, we're going to explore 11 fundamental personal finance rules that, surprisingly, our classrooms may have missed. These are the golden nuggets that can pave your path to financial wisdom and success. 1. Understanding debt. The double-edged sword. Debt is a powerful tool, but like a double-edged sword, it can build or break your financial future. When you borrow, you're not just taking money. You're committing future earnings to pay back with interest. High-interest debt, like credit card balances, can be particularly insidious. It's not just the initial amount, it's the compounded interest that grows over time, eating into your potential savings. However, not all debt is bad. Managed wisely, loans like mortgages or student loans can be investments in your future. The key is understanding how to differentiate between constructive and destructive debt and managing it to your advantage. 2. The power of investing. Making money work for you. Investing is the art of making your money work for you. It's about taking calculated risks to allow your wealth to grow over time. This growth is crucial in outpacing inflation, which erodes the purchasing power of your money. Think of investing as planting a diverse garden. Just as different plants thrive in varying conditions, diversifying your investments across stocks, bonds, and real estate can help balance risk and reward. Moreover, the concept of compound interest in investing means that your investments not only earn returns, but those returns earn more returns. It's this compounding effect that can turn modest savings into significant wealth over the long term, securing your financial future. 3. Beyond saving. The wealth-building formula. While saving is an essential habit, it's only the first step in wealth building. The real magic happens when you combine saving with smart investing. Let's break it down. Saving money in a bank earns minimal interest, often not enough to keep up with inflation. This is where investing comes into play. By investing in avenues like stocks, bonds, or real estate, you give your money the potential to grow at a much higher rate. It's about creating additional income streams beyond your regular paycheck. This strategy involves not just saving a portion of your earnings, but also learning to invest these savings wisely. Think of it as a two-pronged approach. Saving secures your present, while investing secures your future. 4. Spend less, live more. The art of financial balance. The principle of spending less than you earn is simple yet profound. It's about cultivating a mindset of mindful spending. This doesn't mean you must live a life of extreme frugality or deny yourself enjoyment. Instead, it's about prioritizing your spending on what truly matters and cutting back on unnecessary expenses. Creating a budget and tracking your expenses can be incredibly eye-opening, revealing where your money actually goes. It's like being on a diet. You don't need to stop eating, but you should eat right. By saving on the non-essentials, you free up more money to invest, which can lead to greater financial freedom in the long run. This habit not only ensures financial stability, but also reduces stress and increases your overall quality of life. 5. Demystifying stock investments. Navigating market volatility, investing in stocks is often perceived as high risk. But with knowledge and strategy, it can be a fruitful endeavor. The stock market is inherently volatile. Prices fluctuate based on a myriad of factors, from economic changes to global events. However, this volatility can be managed. Long-term investing, as opposed to short-term trading, tends to smooth out these fluctuations. Diversification is key. Spreading your investments across different sectors and even different asset classes can mitigate risk. It's also crucial to invest in companies or funds you understand and believe in. By adopting a disciplined approach, staying informed, and avoiding knee-jerk reactions to market swings, stock investing can be a powerful tool in your wealth-building arsenal. 6. Emergency funds. Your financial lifeline in times of need. An emergency fund is not just a financial buffer. It's a lifeline in times of unexpected crisis. Life can throw a curveball at any moment, be it a job loss, medical emergency, or unforeseen home repairs. Without an emergency fund, these situations can force you into high-interest debt, derailing your financial plans. The ideal emergency fund covers 3 to 6 months of living expenses, providing a cushion that allows you to navigate life's surprises without financial panic. Building this fund takes discipline. It involves setting aside a portion of your income regularly, no matter how small. This fund should be easily accessible, yet separate from your regular accounts to avoid the temptation of dipping into it for non-emergencies. Remember, an emergency fund is not an investment. It's insurance for your financial well-being. 7. The Early Bird's Retirement Plan. Harnessing time and compound interest, beginning your retirement savings early in life is not just a good habit, it's a strategic advantage. The power of compound interest is magnified over time. By starting to save in your 20s, each dollar saved has more time to grow through interest accumulation. Moreover, early savings habituate you to a lifestyle that automatically accounts for future needs. This forward-thinking approach also mitigates the need to play catch-up later in life, a situation where you might need to save a much larger portion of your income to meet retirement goals. Think of early retirement savings as planting a tree. The sooner you plant it, the longer it has to grow and flourish, providing shade in your later years. 8. Lifestyle inflation. The subtle enemy of wealth accumulation. Lifestyle inflation occurs when your spending increases as your income rises, which can be a significant barrier to wealth accumulation. It often starts subtly. A nicer car here, a larger house there. While it's natural to want to enjoy the fruits of hard work, unchecked lifestyle inflation can sabotage long-term financial goals. The key to managing it is conscious spending and maintaining a consistent savings rate regardless of income increases. For example, if you receive a salary raise, it's wise to allocate a portion of that increase to savings or investments rather than expanding your spending proportionately. This approach ensures that as your income grows, your wealth grows too, not just your lifestyle. 9. The magic of compound interest. Turning patience into profit. Compound interest is often referred to as one of the most powerful forces in finance. It works by earning interest on both the initial amount of money and the interest that has already been accrued. Over time, this can lead to exponential growth of your investment. The key factor here is time. The longer you leave your money to grow, the more significant the compounding effect. For young investors, this is a golden opportunity. Even with smaller initial amounts, the prolonged duration allows for impressive growth potential. It's essential to start as early as possible and maintain patience, as the true magic of compound interest is witnessed over long periods. This principle applies to both savings and investments, making it a cornerstone strategy for anyone looking to build substantial wealth. 10. Rules of taxes. Playing the game smartly. Taxes, often perceived as a complex and daunting subject, are an integral part of financial planning. Understanding taxes is akin to learning the rules of an intricate game. Your income, investments, and even everyday purchases are subject to various tax laws. By being tax-savvy, you can make decisions that minimize your tax burden legally and maximize your take-home income. For instance, knowing about tax-deductible expenses, tax credits, and tax-advantaged investment accounts can significantly affect your net income and savings. Additionally, understanding how different types of income, like salary, dividends, and capital gains, are taxed differently can influence your investment decisions. This knowledge empowers you to structure your finances in a way that optimizes tax efficiency. While you don't need to be a tax expert, a basic understanding of tax principles can lead to more informed financial choices, ensuring you keep more of your hard-earned money. 11. You are the most valuable asset. Investing in yourself at the heart of all your financial endeavors is you, your most crucial and often overlooked asset. Investing in yourself goes beyond mere financial terms. It encompasses your health, education, skills, and personal development. Continuous learning and skill enhancement can open doors to better career opportunities and higher income potential. Prioritizing health ensures you have the vitality to pursue your goals. Moreover, nurturing a growth mindset and positive relationships contributes to overall well-being and success. By investing time and resources into personal development, you increase your ability to generate income and handle the complexities of life. This holistic approach to self-investment not only enhances your quality of life, but also ensures that you are continually evolving and adapting, ready to seize opportunities and face challenges head-on. In an ideal world, these lessons would be standard in every classroom. But until then, we're here to fill in the blanks. Remember, the journey to financial literacy is ongoing and ever-evolving. With that said, thank you for watching. And as always, hit the like button, subscribe, and let me know your thoughts in the comments below. Until next time.